Hey everyone, welcome to Money Talks with King George. Today we'll be talking about funding options for startups. So I think this is a topic that a lot of people always try to figure out, like, okay, how do you go around it? And there are so many funding options, but I'll just touch 5 of them today just to give you an idea of some of the quick ways a lot of startups have been able to raise funding for their business. So the first one is this: bootstrapping. I think that's the most common funding option everyone knows. You try as much as possible to reduce your costs, finance everything from your own pocket, your savings, before you pretty much raise any funding round from anybody. So at the very early stage of your startup, it's hard to get funding because except you have a reputation already in the market, but most people don't. So at that point, you need to go in and take all the risk with your own money until you get some form of traction whereby you're able to now make presentations to people and talk to people with money to get some money from them. The second option is customer financing, which is pre-sales. This is an often very effective tool, but most people don't really use it that much. I've seen a lot of companies make money from this, whereby you offer a product that you've not even built and get people to make a deposit for it while you figure out how to build it. So that gives you some room and some leverage regarding what to do to keep your business alive. In a way, this is similar to what people use in platforms like Amazon, whereby customers pay ahead while the product gets taken from where it is and shipped to them. So it's another very, very good way to fund your business. This is very common and it's always advisable if it's possible. A third way is supplier financing. A lot of people don't realize, especially people who are sort of like in the middle of any value chain. So for example, you're not the manufacturer or the producer directly, but you're like the logistics distribution side of the value chain. So if you're creditworthy or have some reputation, you can actually get some of the sellers to give you some credit days. As I've seen clients have 30 to 45 days window whereby they're able to get products, deliver it to wherever they need to sell it, get the money within that same window. So effectively what you're doing is you're financing your business with the supplier's money, which is actually a very good thing, because guess what? Most suppliers actually want to offer it. They want to. It's the only problem they always have is, how do we de-risk it? Like, how risky is it if we give this guy credit? Will this particular business, put us in a bad light regarding payments and all that? So once you're able to show them that it is de-risked to a certain level, you get access to that easily. The fourth one is grants. Grants are common. It's a bit of a different process around grants, but I've seen it being used a lot. Like, there's so many organizations giving grants, though the amount may not be so significant for so many startups, but the organizations that give grants, and those grants are actually very helpful to many businesses. Businesses actually keep themselves alive with grant. Loans are also common. Bank loans. I don't recommend it, but if you don't have any choice, you can finance with loans. I've done businesses with loans actually, whereby I just look at the window. Okay, what's my annual interest on this loan? For example, maybe 6%, meaning I'm paying a 0.5% on the value every month. What's my margin on it? My margin on it is maybe 5%. And what's my cash cycle? My cash cycle is within 30 days, 60 days, I get the full money back. So effectively, I'm going to take 1% to make 5%, so profit of 4%. But bank loans are a bit tricky depending on what society or what country you are in. And then last but not the least in this scenario is venture capital or private equity. Now that's when you already have something that you can take to those people, real investors. Now the caveat is that it's harder getting VC funding and private equity compared to every other process of financing, because there are some requirements. A lot of people, I think a huge chunk of people who apply to some of this funding don't get it, because these guys are very specific in what they want and they have their criteria. So if you don't meet it, the high chances that you get it is very slim. But it doesn't mean it stops your business, because even if you don't get it at this point, at some point if you want to expand, you can always get it. So those are some of the ways you can quickly fund your business. So thanks for listening to Money Talks with King George. See you in the next one.